Stop scrolling right now, because while you're watching this, there's a stock trading at just $15.63. A stock that Wall Street analysts predict will hit $24.75 in the next 12 months. And here's the insane part. This same company already has 13.7 million people trusting it with their life savings. Powers financial transactions for 128 million accounts worldwide, and is quietly dismantling the traditional banking system brick by brick. And get this, it's down 52% from its peak, which means you're looking at a potential opportunity that most investors completely missed. Talking about SOFi Technologies, ticker SOFi, and before you click away thinking this is just another stock pitch, let me show you something that'll make flash multiple headlines rapidly. The math on this is absolutely crazy. If the numbers I'm about to show you play out over the next 24 months, a $25,000 investment today could potentially generate more profit than what most people earn at their actual job. Sound impossible? Stick with me for the next 30 minutes, because I'm going to break down exactly why this isn't hype. It's mathematics, and the headlines coming out about this stock, they're telling a story that almost nobody is paying attention to. Let's dive in. Notice a pattern here? While the stock price has been volatile, ranging from a low of $8.60 to a high of $32.73 in the past year, the underlying business fundamentals are screaming one thing: growth. And here's what makes this even more interesting. The stock closed yesterday at $15.63. It's trading in today's session between $14.93 and $15.89. This volatility, this is exactly where life-changing opportunities are born. Let me take you back to where this all started, because understanding SOFi's origin story is critical to understanding where it's going. SOFi, which stands for social finance, was founded in 2011 with a simple but revolutionary idea. What if banking wasn't just about transactions, but about helping people achieve financial independence? Fast forward to today, and SOFi has evolved into something unprecedented in the financial services industry. They're not just a bank. They're not just a brokerage. They're not just a lending platform. They're not just a cryptocurrency exchange. They're all of it in one app. Think about that for a second. When's the last time you saw a company successfully integrate personal loans and student loan refinancing, high-yield savings accounts, and checking investment accounts for stocks and ETFs, cryptocurrency trading and holding credit cards and payment solutions, insurance products, financial planning services, exclusive member experiences, all under one roof, all seamlessly integrated, all designed with a mobile-first, user-friendly experience that makes traditional banks look like they're operating in the Stone Age? And here's the kicker: they're not just consumer-facing anymore. In 2020, SOFi made a move that most people didn't fully appreciate at the time. They acquired Galileo Financial Technologies for $1.2 billion. Why does this matter? Because Galileo is the infrastructure, the pipes and plumbing, if you will, that powers financial technology across the globe. Let me put this in perspective. 128 million accounts globally run on Galileo's technology platform. That's not SOFi's consumer members, that's separate. These are accounts for other fintechs, financial institutions, and brands that license SOFi's technology. Companies like Chime, Robinhood, Revolut, and countless others rely on Galileo to build and manage their financial solutions. This is the equivalent of Apple not just selling iPhones to consumers, but also licensing iOS to Samsung, Google, and every other phone manufacturer on the planet. It's a massive moat and a recurring revenue stream that most retail investors completely overlook, while everyone focuses on SOFi's consumer lending business, which is fantastic in its own right. This B2B technology platform is quietly building a financial infrastructure empire that could be worth more than the entire consumer business within the next few years. Let's talk cold, hard numbers, because that's where the real opportunity reveals itself. Current stock price, $15.635 to dollars week low, $8.60, $52.32, 73 year ended, 12 cents. That target represents a potential 58% return from current levels in just 1 year. But here's what gets me excited. Market cap, $20.2 billion for a company that serves 13.7 million members directly, processes transactions for 128 million accounts globally, holds a banking charter, and is growing at triple-digit rates in several key segments. That market cap is laughably low. Let me put this in context. Morgan Chase $560 billion market cap, Bank of America $320 billion market cap, Wells Fargo $210 billion market cap, Block $45 billion market cap, PayPal $80 billion market cap now. I'm not saying SOFi will reach JP Morgan's size tomorrow, but if SOFi captures even 5 to 10% of the market share in the demographics it targets, millennials and Gen Z, who are abandoning traditional banks in droves, we're looking at a company that could be worth $100 to $200 billion within the next 5 to 7 years. If you invested $10,000 today at $15.63 per share, and SOFi reaches even a $50 billion market cap, that's 2.5x from here, your investment would be worth $25,000. If it reaches $100 billion, your $10,000 becomes $50,000. These aren't pie-in-the-sky projections. This is simple math, based on market penetration in a TAM total addressable market. Worth trillions, here's something that changed the game for SOFi in 2022. They received their national bank charter. Most people have no idea how significant this is, so let me break it down. Before the bank charter, SOFi had to partner with other banks to hold deposits and make loans. This meant sharing revenue with partners, less control over the customer experience, higher costs, regulatory limitations. After the bank charter, SOFi can now hold deposits directly, cheap funding, make loans on their own balance sheet, better margins, offer FDIC insurance directly to members, control the entire vertical stack of financial services. This is a massive competitive advantage. While other fintechs are still dependent on bank partners, SOFi has become a full-stack financial services company. The numbers speak for themselves. Since receiving the bank charter, SOFi's deposit base has grown from essentially zero to over $15 billion. That's low-cost funding that SOFi can now use to make loans at much higher margins than before. Traditional banks pay money market rates to acquire deposits. SOFi offers competitive rates but pairs them with an incredible user experience, financial tools, and a community that keeps members engaged. The result? Stickier deposits, lower acquisition costs, and higher lifetime value per member. Let's talk about SOFi's most important metric, member growth. 13.7 million members and counting. But it's not just about the quantity, it's about the quality and trajectory. Quarter over quarter, SOFi has been adding members at an accelerating rate. Even more impressive, the company's cross-buying metrics, meaning members who use multiple SOFi products. Think about this logically. When you use one financial product from a company and have a good experience, what happens? You try another, then another. Maybe you start with a student loan refinance. Then you open a SOFi checking account for the better interest rate. Then you try their investment platform. Then you get their credit card. Then you buy crypto through their app. Each product you use creates switching costs, the psychological and practical barriers to leaving for a competitor. SOFi reports that members using 3 or more products have a retention rate above 95%. That's insane. That's Apple-level customer loyalty in the financial services industry, which is notorious for low engagement and high churn. And here's the beautiful part, most of SOFi's 13.7 million members are millennials and Gen Z, people in their 20s. 30 Sekunden and early for, just entering their peak earning years. Financial services companies measure lifetime value, the total profit. Could easily exceed $10,000, $50,000 in gross profit over decades. Multiply set by 13.7 million current members. Plus the millions more SOFi will add in coming years. And you start to understand the compounding power of this business model. Now let's zoom out and look at the macro trends that are acting as rocket fuel for SOFi's growth. Trend number 1, the death of traditional banking. According to multiple studies, 73% of millennials would rather go to the dentist than listen to what banks have to say. Over 50% of Gen Z consumers have never stepped foot in a traditional bank branch. Digital-only banking adoption is growing at 23% annually. Traditional banks are bleeding young customers. And those customers are flocking to digital-first experiences like SOFi. Trend number 2. The fintech revolution. The global fintech market is expected to grow from $245 billion in 2023 to over $700 billion by 2030. That's a compound annual growth rate of nearly 20%. SOFi isn't just riding this wave. Through Galileo, they're providing the infrastructure that's making this wave possible. Trend number 3. The great wealth transfer over the next 20 years. Baby boomers will transfer an estimated $68 trillion in wealth to younger generations. That's the largest wealth transfer in human history. Where do you think that money is going? To banks with marble columns and 3% APY savings accounts? Or to innovative platforms like SOFi offering for 0.5% APY, free financial planning, and a seamless mobile experience? Trend number 4, the everything app opportunity in Asia. Apps like WeChat and Alipay have become super apps. Single platforms where users do everything from messaging to payments to investing to shopping. The United States doesn't have a dominant financial super app yet. SOFi is positioning itself to be exactly that, the one-stop shop for all financial needs. Currently, SOFi's 13.7 million members represent less than 5% penetration of their target demographic in the United States alone. The TAM is massive, and SOFi is still in the early innings of market capture. Here's where the story gets really interesting for investors. SOFi has reached profitability. For years, like many high-growth tech companies, SOFi prioritized growth over profits. They were investing heavily in customer acquisition, technology development, and building their infrastructure. Critics said they'd never be profitable. They said the unit economics didn't work. They said it was just another cash-burning fintech that would collapse. They were wrong. In recent quarters, SOFi has demonstrated positive adjusted EBITDA, improving operating leverage, path to sustained GRP profitability, strong free cash flow generation. This is the inflection point that transforms a stock from a speculative growth play to a legitimate financial services powerhouse. When a high-growth company proves it can grow and be profitable, that's when institutional investors, the big money stacking notes, and that's exactly what we're seeing. Institutional ownership in SOFi has been steadily increasing. Smart money is accumulating while the stock is still under the radar. So why April 2026? Why could this stock potentially pay you more than your job by that date? Let me lay out the scenario. Current price: $15.63 analyst 1-year target, $24.75 conservative 2-year target based on fundamentals. 3.5 for 5 bull case 2-year target, $50 to $70 now. I know what you're thinking, these sound like aggressive targets. So let me explain the math. If SOFi achieves the following by April 2026, grows members from 13.7 meters to 5M. Very achievable given current growth rates, increases products per member from 1.8 to 2.5. Maintains current revenue per product, likely conservative as ARPU typically increases. Achieves 15% net profit margins in line with mature fintech companies. You get 25 meters members times 2.5 products times $500 revenue per product equals $31.25 billion in revenue at 15%. Margins equals $4.7 billion in net income at a conservative 25p. E multiple equals $117 billion market cap. Current market cap $20.2 billion. That's a 5.8x return in 2 years. Let's make it a conservative investment. 10,000 stock hits $35 body per 22.24x. Your investment at $20,400. Gain $12,400 scenario to moderate investment. $10,000 today stock hits $50 by April 2026. 2x your investment is worth $32,000. $22,000 scenario 3 bull case investment. $5,000 today stock hits $70 by April 2026. 4.4x your investment is worth $112,000. Gain $87,000. Could this pay more than your job? If you make $60,000 per year at your job, you'd earn approximately $120,000 over 2 years before taxes. In the moderate scenario, a $37,500 investment returning 3.2x would yield $120,000, matching your job's total earnings. In the bull case, a $26,785 investment returning 4.48x would yield $120,000, again, matching 2 years of job earnings. Important disclaimer appears now. Before we go further, I need to be crystal clear. I am not a financial advisor. This is not financial advice. These are projections based on fundamental analysis, and stocks can go down as well as up. You should never invest money you can't afford to lose, and you should always do your own research. That said, the risk-reward profile here is compelling for those who understand what they're investing in now. Let's talk about what could go wrong, because no investment thesis is complete without addressing the risks. Risk number 1, economic recession. SOFi's lending business, particularly personal loans, is sensitive to economic conditions. In a severe recession with high unemployment, loan defaults could spike, hurting profitability. Risk number 2, rising competition. Every major bank and fintech company sees the same opportunity SOFi does. Competitors like Chime, Robinhood, Cash App, and traditional banks with digital offerings are all fighting for the same customers. Risk number 3, regulatory changes. Financial services is one of the most heavily regulated industries. Changes in banking regulations, lending rules, or fintech oversight could impact SOFi's business model. Risk number 4, interest rate sensitivity. As a bank, SOFi's profitability is affected by interest rate environments. The spread between what they pay on deposits and what they earn on loans drives margins. Risk number 5. Execution risk. SOFi is trying to build something unprecedented, a full-stack financial services super app. There's always risk that execution doesn't match ambition. Risk number 6. Stock volatility, as we've seen with the 52-week range of $8.60 to $32.73. SOFi stock is volatile. If you can't stomach 30 to 50% drawdowns, this stock will test your conviction how to manage these risks. Don't invest more than you can afford to lose. Consider dollar cost averaging instead of lump sum investing. Diversify. SOFi should be part of a portfolio, not your entire portfolio. Have a 3 to 5 year time horizon minimum. Monitor quarterly earnings and business metrics. So with all that context, why is now potentially the right time to consider SOFi? Reason number 1. The stock is down 52% from highs. At $32.73, SOFi was pricing in perfection. At $15.63, the stock is pricing in significant skepticism despite improving fundamentals. The risk-reward has shifted dramatically. Reason number 2. Profitability has been achieved. The biggest bear case against SOFi, that it would never be profitable, has been proven wrong. This removes a major overhang on the stock. Reason number 3. The bank charter benefits are just beginning. SOFi only received their bank charter in early 2022. The deposit growth and margin expansion from this advantage is still in early stages. Reason number 4. Member growth is accelerating, not slowing. Many mature tech companies see growth slow down. SOFi's member acquisition is actually speeding up, suggesting they're still early in the adoption curve. Reason number 5. The market hasn't priced in Galileo's value. Most retail investors don't understand or value the Galileo platform. As this B2B infrastructure business grows, the market will be forced to re-rate the stock higher. Reason number 6. Institutional accumulation is increasing. Smart money is buying while retail investors are distracted by AI stocks and meme coins. Current daily volume, 53.2 million shares. Average volume, 66 million shares. The stock is liquid, actively traded, and institutions can build meaningful positions. If you're considering investing in SOFi, here's the framework I'd suggest. Step 1. Understand what you're buying. You're not buying a stock ticker. You're buying ownership in a company that serves 13.7 million consumers directly, powers financial infrastructure for 128 million accounts, globally holds a banking charter with $15 billion in deposits, is growing revenue 30–40% year over year, has achieved profitability ahead of schedule, targets the largest generational wealth transfer in history. Step 2. Determine your conviction level. High conviction. Consider a larger position. Medium conviction. Start with a smaller position and add on dips. Low conviction. Maybe SOFi isn't right for you yet. Do more research. Step 3. Choose your strategy. Lump sum. Buy your full position now. If you believe we're at a bottom. Dollar cost averaging. Buy a set amount. Weekly, monthly, regardless of price. Buy the dips. Set price targets and add when stock pulls back. Step 4. Set your time horizon. Trading weeks, months. Higher risk. Requires active management. Investing 1 to 3 years. Medium risk. Perfect for the April 2026 thesis. Long-term holding 5 years. Lower risk. Highest potential returns. Step 5. Monitor but don't obsess. Check quarterly earnings. Track member growth and products per member. Watch deposit growth and loan portfolio quality. Don't panic over daily price movements for most investors. SOFi should represent 2 to 10% of a diversified portfolio depending on risk tolerance. This allows for meaningful upside if the thesis plays out, while limiting downside if things go wrong. Here's what excites me most about SOFi, and it goes beyond just making money on our stock. We're witnessing the transformation of an entire industry. Banking hasn't fundamentally changed in 100 years. Sure, we have ATMs and mobile apps now, but the basic model, take deposits, make loans, charge fees, is the same. SOFi represents something different, banking reimagined for the digital age. A world where you don't pay account fees, you earn competitive interest on savings, you have free access to financial planners, you can buy stocks, crypto, and traditional investments in one place. You're part of a community. Not just a customer number. Your bank actually helps you achieve financial independence. This isn't just a better mousetrap. This is a fundamental shift in how millions of people will manage their financial lives over the next 20 to 30 years. And if you believe that shift is happening, if you believe that your kids won't bank at Chase or Wells Fargo, but at digital-first platforms like SOFi, then this stock at $15.63 is potentially the opportunity of the decade. So let's bring this back to our title. This one stock could pay you more than your job. Is it guaranteed? Absolutely not. Investing never is. But is it possible? The math says yes is IT probable. If SOFi executes on even 70% of its potential, this stock will be significantly higher in April 2026 than it is today. Current price, $15.63 1-year target, $24.75 the real question. Where will it be in 2 years when the bank charter advantages fully materialize? When member count potentially doubles? When Galileo's value is properly recognized? And when SOFi proves it can be both a growth story and a profitable financial institution? Here's what you need to remember. SOFi is not just a lending company. It's a full stack. Block 50. Financial services super app, 13.7 million members and 128 million accounts globally show real traction. The banking charter is a game-changing, competitive advantage. Profitability has been achieved. Removing the biggest bear case, the stock is down 52% from highs despite improving fundamentals. Analysts see 58% upside in just 1 year. The long-term bull case suggests 3 to 5x potential by April 2026. Look, I get it. Investing is scary, especially in volatile stocks like SOFi. But here's what I know. The biggest returns in investing don't come from buying what's comfortable and popular. They come from buying quality companies when they're unloved, undervalued, and underappreciated. Right now, while everyone is chasing AI stocks trading at 50x sales, SOFi is quietly building the financial infrastructure of the future at a $20 billion market cap. The opportunity is there. The research is in front of you. The decision is yours. If you found this analysis valuable, smash that like button. It helps more people discover this opportunity. Subscribe and hit the notification bell for more deep dives into stocks with asymmetric risk-reward profiles. And drop a comment below. Are you bullish or bearish on SOFi? What price would make you a buyer? Remember, this is not financial advice. I'm sharing my research and analysis. You need to do your own due diligence before investing a single dollar. But I'll leave you with this final thought. In April 2026, you'll look back at this moment. The only question is whether you'll wish you'd taken action or be glad that you did. The choice, as always, is yours.